FRM Part 1, Financial Markets and Products. Next aim statement is interest rate futures. We have already talked about the futures and forward contracts on commodities, stocks and foreign exchange. Now let us look at these futures in the context of interest rate. Under the same statement, we'll first identify what are the most commonly used conventions for day count, which describe the market and typically used in that particular case. And then we also learn to apply it for interest calculation, typically for the accrued interest case. Then we learn to calculate the conversion of a discount rate to the price for a treasury bill. Then we'll differentiate between the clean price and dirty price for a US treasury bond. And then we learn to calculate the accrued interest and dirty price, which is the full cash price, including the accrued interest for a treasury bond. Then we'll explain and calculate what is the contract conversion factor for US treasury bond futures. And we look at the cost of delivering a bond into treasury bond futures contract. And then we look at the impact of the level and shape of yield curve on cheapest to deliver bond decision. So we look at the cost involved in delivering a bond and find out which is the cheapest to deliver. Then we calculate the theoretical future price for a treasury bond futures contract and final contract price on a euro dollar futures contract. Then we describe and compute the euro dollar futures and including the convexity adjustment. Then we explain how euro dollar futures can be used to extend the Libor zero curve. So this zero curve or spot rate curve can be constructed using these euro dollar futures rate. We'll look at the mechanism. Then we learn to calculate a duration based hedge ratio so that portfolio of the bonds can be protected against a small change in the yield curve. And we discuss these duration based hedging strategies using interest rate futures. And finally, we'll understand the limitations of using this kind of duration based hedging strategy. So let us start with day count conventions. So generally in interest rate calculations, we have three kinds of conventions which are used. First is actual by actual. This is used for US treasury bonds. So for example, it is a semi-annually paying bond. So there are 180 days after which the coupon will be paid, and so far say 54 days have passed. So in order to find out the accrued interest, we'll have 54 by 180. Suppose this actual number is not 180, it is say 183 for those 6 months, then we are going to use 183. So it is actual by actual. And the next convention is 30 by 360. This is used in case of US corporate bonds and municipal bonds. Here for every month we are going to use 30, assuming 30 days in every month, and the year has 360 days. So this is the assumption here. So for example, if we are talking about annual coupon paying bond, so we'll have 360 in the denominator, and suppose we are calculating say from January 1st to March 13th. So we'll count 2 months, January and February, into 30. So that makes it 60. And then from 1st March to 13th March plus 12 more days. So there will be total 72 days. So this is how we do the calculation in the municipal bond and corporate bond case. The third important convention is this actual by 360. This is used for US treasury bills and many other money market instruments. For example, certificate of deposit, commercial paper, etc. In those cases we follow this convention. We have actual number of days like we had here, 54 days we counted, and then that has to be divided by 360. We are assuming there are 360 days in a year. Now to further understand this clearly, let us take a numerical example where we calculate it for all three cases. Suppose the face value of the bond is $100. The coupon it is paying is 8%. The payment is semi-annual and it is paid on March 1st and September 1st. So these are the days on which the payment is made. So let us take the first case. We have to calculate when the settlement is happening on 12th of July. So we need to calculate the accrued interest. First case is where we are talking about treasury bond. For example, for treasury bond, how do we want to calculate? Since it is 8%, so for semi-annual payment, it is going to be $4. $4 is for 6 months. And then from March 1st to July 12th, how many days have actually passed? So March 31 days, then April 30 days, June again 30 days, and July from 1st July to 12th July, 11 days. So let us add this. Sorry, for March there were 31, April 30, and for May we need to have 31, then for June 30, March, April, May, June, and then for July we have 11. So now if we add it, we get 133. So these are the days. And if we calculate the actual days, because in the denominator also we need to have actual number of days, we have March 31, April 30, May 31, June 30, July 31 and August 31. These days have to be added together. So we have 184 days. So that will go in the denominator. 4 into 133 divided by 184 is 2.891. This is the accrued interest up to July 12th for treasury bond. Now let us assume that the same details are for a US corporate bond where the convention is 30 by 360. So let us count the days for that case. As we have discussed, they have to be 30 days in each month for this. So for March 30, April, May and June. Then for July again 11 days. These are full months. So the answer is 131. And in the denominator we have 360, 30 by 360, that is the convention we are following, and $8 is for 360 days. That is why we are using 8 here. In the case of treasury bond we are using $4 because that is what was there for 184 days. Here it is $8 for 360 days. And the calculation gives us 2.911. This is the accrued interest. As we can see, this is slightly higher than the case of treasury bond. Now let us look at the third case of US treasury bills. What happens in that case? It is actual by 360. We already counted. Actually it is coming 133 days, and in the denominator we need to have 360 as per the convention here, and 360 days have $8 as coupon. So we multiply it and we get 2.955. So this accrued interest is the highest as compared to the treasury bond and the corporate bond. So this is how these various conventions make a difference on the calculation of accrued interest. So we need to just remember that for these treasury bond it is actual by actual, for corporate and municipal bond it is 30 by 360, and for money market instruments, treasury bills, etc., it is actual by 360. Now let us move to the next concept, the price convention for a treasury bill. Let us see how do we describe it in terms of discount price. As we know that treasury bills are represented in terms of discount rate, not just the price, which is a percentage of par value. Suppose it has 1 year to expiry and the discount rate is 6%, then it will be traded at 94, assuming that $100 is the par value. So it will be described as we see that it does not represent the true yield. Yield on this might be higher. For example, that has to be taken as a percentage of 94 That was the present value or the price in this case. But discount rate is taken as a percentage of par value. So that is why it is not true yield on the bond. And as we have already seen, actual by 360-day convention is to be used. Let us take an example. Suppose there is a par value is $100 for a treasury bill. Days to expire is 60 and it is represented as discount of 9. So we can understand it is 9% discount rate to $100, which is the par value, and that is defined for 360 days. So we need to find out what is the price when days to expiry is 60. So for that I have to use a formula which will be given by this 100 minus n by 360. N is days to expire into quoted discount. So that will give me like this, n by 360. So 60 by 360, and discount is given as 9%. 9 is for 360 days. So for 60 days it is going to be 1 by 6 of that. That is 1.5. So 1.5 is the actual discount for 60 days, and when we subtract from 100 it becomes 98.5. So this is the price at which this treasury bill is being traded at, that is cash price, and it is represented as discount of 9. But we need to remember that this discount which is given is always for 360 days. Since in this case the actual days to expiry were 60, so that is to be used in numerator. Now on the same thing, if we want to calculate the true yield, we know that can be easily calculated using the cash price. So we need to divide this 9% by 98.5. We simply get 9.14%. So 9 was discount for 1 year and the current price is 98.5. So this will give us the true yield. Then if we want to convert price to discount, we have already seen how to convert discount to price. If you want to do the other way around, then we can simply use 360 by n into 100 minus y. That is just opposite of it. So if we have n which is 60 and the cash price is 98.5 as we have seen in this case, so T-bill discount rate is going to be 360 by n, that is 6 into 100 minus 98.5, which is 1.5. So this gives us 9%. That was the discount rate. So we have both the formula with us. We can convert from discount rate to cash price and cash price to discount rate. And similarly, we have the pricing of treasury bonds. Let us see how it is different. Using treasury bond, we have two concepts, clean price and dirty price. As we know, in the case of treasury bills, there is no coupon. So because of that, there is no concept of accrued interest in the case of treasury bills. But for treasury bonds, the concept of accrued interest brings a difference between two rates, the clean price and dirty price. Clean price is the one where we are not considering the accrued interest, and dirty price is nothing but the summation of clean price and the accrued interest. Since there might be a trading on a day where the coupon is not being paid, suppose coupon was paid between, so it is paid on January 1st and say June 1st or July 1st. So these are the days where coupon is paid, but it might be trading at some other day between them. So we need to understand what is the accrued interest till that point. So as we have already seen, the cash price or the dirty price is the quoted price, which is nothing but the clean price or the present value of the bond plus accrued interest rate. So when we say cash price, we talk about both clean price and accrued interest. So dirty price includes both. Let us take an example here. Suppose there is a $100 par value bond which is paying semi-annually. So these are the dates, March 1st and September 1st, where the coupon payments are made. Coupon rate is 8%, and this treasury bond is quoted at 100 to 11 on July 12. So we need to find out what is dirty price. Before that, we need to understand the quotation. The treasury bonds are quoted at divide by 32 price. So when I say the price is 102.11, that means 102 plus 11 by 32. So that gives us the actual price. So this is a convention which we need to remember. Bond price will be quoted at 102-11. Dash 11 means 102 plus 11 by 32. So that needs to be remembered in the context of treasury bonds. Now if we want to calculate the quoted price first, or the clean price, first we need to find out what is the clean price. This is 102 plus 11 by 32, 102.34375. This is the quoted price. Now let us calculate the accrued interest so that we can find out the dirty price or cash price. Accrued interest, we have already learned the calculation for accrued interest. This is $4, which is payment for half year, that is 184 days. We do actual by actual in the case of treasury bonds. So actual number of days till 12th of July we have already seen is 133, and actual days for half year is 184. If we use it, we get 2.891. That is our accrued interest. And now if we want to calculate the dirty price or cash price, we just take the summation of 102.34 plus 2.89. So we get 105.23. So this is our dirty price of the bond. Now let us move to the next concept, which is the treasury bond futures. So we are talking about the treasury bonds. Let us see how the futures in them are priced. So as the name suggests, treasury bond futures will nothing be but a promise to buy or sell treasury bond at a particular date in future. So in the T-bond futures contract, delivery can be made of any treasury bond with a maturity greater than 15 years and which is also non-callable for next 15 years. So this is given by the exchange. The Chicago Board of Trade generally defines what is the conversion factor for all the bonds. Any of those bonds can be delivered. So on delivery, the cash will be received by the short position, which can be simply calculated as the quoted future price, which will be given into conversion factor that is defined by the Chicago Board of Trade for different treasury bonds every day. And when we can calculate accrued interest, we can just add it up. So this is the cash received by short position or cash provided by the long position in the case of treasury bond futures. Yeah, as we have said, treasury bond have different conversion factors which will be provided by Chicago Board of Trade. So out of them, the short position holder can select which bond is to be delivered, and the cash received can be calculated using this formula. So let us take one example here. Suppose the quoted bond price for futures, say it is 95, and the conversion factor given for a particular bond is 7.2. Then we can add the accrued interest. Suppose the accrued interest comes out to be 2.89. Then we can just calculate and we get the cash received by short position. We will take a few more examples later. Let us find out how to calculate the cheapest to deliver bond. Since we have seen the short has an option to pick up any of those treasury bonds and deliver them, how does a person find which is the cheapest to deliver? Since there is a cost associated with the delivery of every bond, the short position holder has to find out where the cost is minimum. As we have seen, the conversion factor system alone does not provide a homogeneous mechanism for delivery. There will be a different cost associated with different bonds. It is not uniform. Since conversion factor is given, but that does not take care of it completely. So we need to minimize the cost of delivery of the bond, which can be given by quoted bond price in the market minus QFP, quoted future price, into conversion factor. We have seen that we multiply these two and add the accrued interest to find out the cash received by short position holder. But we need to find out what is the cost associated. Since these two are not equal, there will be a small difference between these two that refers to the cost of delivering the bond. So for whichever bond this cost is minimum, that will be selected and delivered. So it will be the cheapest to deliver bond. There are some other considerations while delivering a bond. When the yield is high, suppose it is greater than 6%, then that is generally believed to be high. We deliver the bonds with high duration. So high duration bonds are the one which have longer time to maturity and very low coupon payments. While on the other side, if the yield curve says the yield is low, less than 6%, then we favor low duration bond, the bonds where the time to maturity is low and the coupon payments are high. Similarly, if we have upward sloping yield curve situation, we prefer long time to maturity bonds, and if it is downward sloping yield curve, we prefer short time to maturity bonds. We can take an example. Suppose the quoted bond price in the market for a particular bond is say 98, and we know that quoted future price of the bond is say 95, and the conversion factor is given to be 1.2. So we need to just take the difference, and then if there is another bond which has quoted price is 97 and its conversion factor is given to be say 1.3, we calculate this, and whichever of them is minimum, that bond will be selected for delivery. So this is how we use cheapest to delivery concept. Let us move to the next concept, which is euro dollar futures. So we have a different kind of interest rate futures here in terms of euro dollar. Let us understand it. 3 months euro dollar future contract, which are traded at Chicago Mercantile Exchange, are the most popular interest rate futures in US. They are based on $1 million face value deposited outside US. So it is assumed that the notional value is going to be $1 million, which is to be borrowed or lent by somebody. And since it is assumed to be deposited outside US, it is not regulated by US agencies. And the underlying interest rate which is used is 90-day forward Libor. So this is not the treasury bill rate, it is London interbank offer rate, which is used as an underlying for euro dollar futures. So based on the movements of Libor, the price of euro dollar future will change. So this is the underlying which is going to determine the price of the derivative, which is euro dollar future in this case. So the price of euro dollar future can be calculated as this formula: 10,000 into 100 minus 0.25 into quoted price. So from where this formula is coming, we have $1 million as face value, right? And 100 minus, this is for percentage, then it is 90-day forward rate. So 90 divided by 360 into quoted price. So that is the Libor rate. And then we have to divide by 100 since it is just the percentage. So this 1 million divided by 100 becomes 10,000. And this 90 by 360 becomes 0.25. And this is the quoted price. So 0.25 into quoted price, and then we subtract it from 100, we get the rate. So this clearly says that one tick is equivalent of $25. So if there is one small change, minimum changes will be equivalent to $25 in this case. So let us say if the quoted price happened to be 98.2 for a euro dollar, then what will be the futures price? We just put these values: 10,000 into 100 minus 0.25 into quoted price. Quoted price is 98.2. So it is divided by 4. 24.55. And then if we subtract, we get 75.45. This into 10,000. So we get 7545,000. So this will be our euro-dollar futures price. So if we have to find out what is the underlying interest rate here, that is 90-day Libor, that is nothing but 100 minus Z, which is the quoted price. So quoted price was 98.2, so Libor is going to be 1.8 in this case. So this is the 90-day Libor. Suppose it is 1.8%, automatically the quoted price becomes 98.2. So that is 100 minus Z. This is Libor, 100 minus Libor will become our quoted price. So that is to be put here. And using the formula, we can calculate the futures price for a euro-dollar. Now let us look at one adjustment to this formula, convexity adjustment. So we have actual forward rate that will be given by forward rate implied by the futures, which we have calculated, minus half into sigma square into T1 into T2. So this is the adjustment for the convexity. Since it does not follow a linear relationship, there is curve. So because of that, we have this adjustments for the convexity. Here T1 is nothing but the maturity on the futures contract. T2 is the time to maturity for the underlying contract, which is 90 days in this case. And the sigma is the annual standard deviation of change in underlying rate, which is 90-day Libor in this case. So we know all three values. Accordingly, we can have this convexity adjustment. This is convexity adjustment to the forward rate, which has been implied by the futures. So we can calculate the actual forward rate with this adjustments. So automatically, if the maturity on the future contract T1 is higher, we are going to have a higher adjustment for convexity, and automatically the actual forward rate will be lower than the forward rate implied by the futures. Similarly, if the annual standard deviation in underlying rate Libor or the volatility of the Libor is higher, then also the effect of convexity will be higher. The convexity adjustment will be higher and the actual forward rate will be lower than the forward rate implied by the futures. So this was about the convexity adjustment. Let us move to the next concept, the Libor spot curve. So this can be constructed using euro-dollar futures. Let us see how do we do it. The forward rate between time T1 and T2 is given by this formula. The forward rate for the euro-dollar, R2 into T2, the rate for period corresponding to time T2, and R1 is the rate corresponding to T1, and this is the time difference. So forward rate is the interest rate between the time period T1 and T2. For example, if T1 is say 3 months and T2 is say 6 months, so our forward rate will be the interest rate which will be applicable for 3 months from now. So for this period, suppose this is 0, this is 3, this is 6 on the timeline. So our forward rate will be applicable in this period. So that can be given from euro-dollar future rate. So if we already know R forward, we can calculate the value of R2. So since our Libor spot curve is going to have these values, R1 for time T1, then R2 for time T2, this is R1, R2, R3 for time T3. This is nothing but the spot rate curve or zero curve for Libor. So if we know R1, T1 and T2 and we have R forward rate for time period between T2 and T1, we can easily calculate R2. So R2 can be calculated. Similarly, if I know R2, T2, T3 and the R forward between T2 and T3, then I can automatically calculate R3 and so on. So I can keep calculating these values R1, R2, R3 and so on, and I can construct Libor zero curve or Libor spot curve, which represents the spot rate for different time periods. Now let us move to the next topic, which is duration based hedging. As we already know, hedging means to protect our portfolio from a sudden change in the value, and here we are talking about hedging a position against small change in yield curve. As we know that there is opposite relationship between the price and the yield curve. So for higher yield, the price will fall. If the yield falls, then price will rise. So there is a relationship, though not linear relationship, but there is a inverse relationship between price and the yield curve. So if you want to hedge our bond portfolio against any rise in the yield curve, then we have to make the duration of the portfolio as 0. As we know that duration is a parameter that represents interest rate risk. If the duration of our portfolio is high, suppose duration is high, then on yield curve rise, price fall is going to be more. And if duration is small, then on yield curve rise, the price fall is going to be small. So the duration represents the interest rate risk. If the duration of the whole portfolio is 0, that means even if yield curve rises, the value of the portfolio is not going to fall. So that is the protection against change in the yield. So this is the formula which is given to calculate duration based hedge ratio. So number of contracts which are required to hedge our portfolio is given by minus P into dP, that is the value of the portfolio, P into duration of the portfolio, divided by F into DF. DF is the duration of the future and F the value of one contract of the bond. So this will give us how many interest rate futures we need to short. Negative sign signify we need to short in order to make the duration of the portfolio 0. Since this is the portfolio duration now, this is the portfolio duration for one contract. So this into N will neutralize the current duration of the portfolio. So overall duration will become 0 once we are shorting these many contracts. There is one limitation of the duration, as we have already seen that this curve is not linear. There is convexity involved, so that has to be adjusted a little bit. Only then we will be able to understand. Or in other words, we can say if the yield change is very small, then the duration itself can capture the whole interest rate risk. But if the yield curve change is large, then we will not be able to completely rely upon duration itself. We need to take into account the convexity as well. Let us take one example in order to understand how to hedge our portfolio. Suppose the value of our portfolio is $10 million and the duration is 14. So we can write it here. The value of the portfolio is 10 million. The duration of the portfolio is 14 and we want to hedge it. So we want to make the overall duration of the portfolio to be 0. So it has to be hedged with 6 months. It has to be hedged for 6 months. So we have a 6-month treasury bond which is quoted at 104-08. So we can convert it into price, which is 104 plus 8 divided by 32, which is nothing but 104.25. So this is the price. Contract size is 10,000 and the duration is 15. For this bond, duration is 15, which is DF. So we can calculate N, which will be given by 10 million P into 14 dP divided by F. This is DF, and F can be calculated by just multiplying the price, and since contract size is 10,000, so we need to multiply it by 10,000. So it is divided by 100. So this should be 10425, not the 0. So N will become minus 8.9528. So we need to short 9 contract. Sorry, 900 contract, since the answer is going to be minus 895.28. So we need to short about 895 contract. So these many contracts need to be shorted so that it makes the portfolio duration equal to 0. Now this was the basics of various interest rate futures. Let us